Most people treat their Roth IRA like a random collection of ETFs. Buy this one, try that one, hope for the best. But one college professor I know built his Roth IRA very differently. Every ETF has a role. Every dollar has a purpose. And the goal isn't excitement, it's tax-free wealth for life. Today, I'll show you the 5 ETFs he uses in 2026 and why they're designed to be held forever. Welcome to John Explains Finance, where we keep investing simple and smart. If you like clear, no-nonsense money breakdowns, hit subscribe so you don't miss the next one. All right, let's break this down.
First, why Roth IRA even matters. Before we talk about ETFs, we need to understand the account. A Roth IRA is powerful for one big reason. You pay taxes now, but later, you pay zero. If you invest $7,000 this year and it grows to $70,000 in 20 or 30 years, you don't owe tax on that growth. Zero. If it grows to $300,000, still zero. If your investments start paying you income in retirement, still zero. That's why picking the right ETFs inside this account is such a big deal, because whatever grows in here grows tax-free.
Now let's talk about how this professor builds it. He doesn't guess. He doesn't chase hype. He uses 5 clear pieces. Each one has a job.
ETF number 1, the simple autopilot option. This one is for people who don't want to think too much. It's called a target date fund. Here's how it works in simple words. When you're young, it holds mostly stocks, more growth. When you get older, it slowly adds bonds, less risk. It adjusts automatically over time. You don't rebalance. You don't tweak. You don't stress. You just keep investing. The professor says this is perfect for busy people. If you want easy mode, this alone could work. But he personally likes more control. So let's move to the core of his portfolio.
ETF number 2, the foundation, S&P 500. This is the base, the backbone, the S&P 500. This fund owns 500 of the biggest companies in America: Apple, Microsoft, Amazon, Google, big, strong businesses. Historically, the U.S. stock market has returned about 10% per year on average over long periods. Not every year. Some years are bad, some are amazing, but long-term, around 10%. Now, let's do simple math. If someone invests $7,000 per year and earns an average of 10% per year, after 20 years, that could grow to roughly $401,000. After 30 years, around $1.15 million. That's the power of compounding. And remember, in a Roth IRA, that growth is tax-free. That's why this is the foundation.
ETF number 3, Dividend Growth ETF. Now things get interesting. The professor likes getting paid, not by selling investments, but by owning companies that pay dividends. Dividend ETFs focus on companies that share profits with investors. Let's keep this simple. Imagine you build a portfolio worth $500,000. If it earns a 3% dividend yield, that's $15,000 per year in income. If it earns 4%, that's $20,000 per year. And inside a Roth IRA, that income can be tax-free in retirement. Now, important, dividends are not guaranteed. Companies can reduce them, but strong dividend ETFs focus on profitable, stable businesses. This part of the portfolio is about steady income, not hype. ETF number 4, Stability, Short-Term Treasury ETF. Now here's something smart. The professor does not go 100% stocks. Why? Because markets fall. Sometimes 20%, sometimes 30%, sometimes more. If everything you own drops at the same time, that's stressful. So he keeps a portion in short-term U.S. Treasury ETFs. These are backed by the U.S. government. They don't grow fast, but they're stable. They act like shock absorbers. This helps him stay calm when the market gets crazy. Sometimes investing success is about not panicking.
ETF number 5, Growth ETF. Now let's talk about growth. This is where things can move faster. Growth ETFs focus on companies expanding quickly, more innovation, more tech, more future potential. Historically, growth funds have sometimes returned around 12 to 15% annually over strong decades. But they are more volatile. They go up big, they also drop big. The professor adds this because he still has time before retirement. More time equals more ability to handle ups and downs.
Optional wildcard, Bitcoin ETF. Now, in 2026, we can't ignore Bitcoin ETFs. They are easy to buy. No wallets, no passwords. But they are volatile. Bitcoin can drop 50% or more. So, the professor says, if you add it, keep it small. Maybe 5%, maybe 10% max. Only what you can emotionally handle. Because diversification is smart. Overexposure is not. What his portfolio might look like. Here's an example structure. 40% S&P 500, 20% dividend ETF, 20% growth ETF, 15% short-term treasuries, 5% Bitcoin ETF, optional. Simple. Balanced. Each part has a job. Bonus. The almost ETF stock. There's one stock he respects a lot. Berkshire Hathaway. It's run by Warren Buffett. Why does he like it? Because it owns many businesses inside one company. Insurance, energy, railroads, brands. It acts almost like a mini ETF. Over very long periods, it has outperformed the S&P 500. Not every year, but over decades. And that's the time frame he cares about. The big lesson. The professor's secret isn't picking magical ETFs.
The real secret, it's discipline. He invests every year. He doesn't panic sell. He rebalances calmly. He thinks long term. That's it. No hype, no crazy trading, just patience. And inside a Roth IRA, patience is powerful because all that growth stays yours, tax-free. If this helped you understand how to structure your Roth IRA for 2026, subscribe to John Explains Finance. Because here, we keep things simple. No confusion, no complicated talk. Just smart investing made easy. And I'll see you in the next one.